Hello, everyone, and welcome to the Global Energy Outlook from Crisis to Growth. It's another virtual event, of course, and this webinar is hosted by Qatar's the Abdullah bin Hamad Al-Attiyah International Foundation for Energy and Sustainable Development, an independent think tank aiming to provide knowledge and insights on global development and sustainable development topics. Thanks to the Foundation for partnering the FT today. And thank you for logging on to watch. I look forward to your questions and comments. His Excellency Mohammed Sanusi Barkindo, the Secretary General of OPEC, has sent his apologies for being unable to attend due to an extremely urgent last-minute obligation. But let me introduce our speakers on the panel today. We have Laszlo Varro, the Chief Economist of the International Energy Agency in Paris, Lord Adair Turner, Chair of the Energy Transitions Commission, an international think tank in London, Piers Riemer, Director General of the World Petroleum Council, and Jeff Curry, Global Head of Commodities Research at Goldman Sachs. And I'm Derek Brower, US Energy Editor for the Financial Times. We are streaming this event on the platform Bizzabo. This allows for lots of interaction. On the right-hand side of your screen, you can ask questions to the speakers, and you can chat to other delegates in the community function, which can be found on the navigation bar. If you have any problems, please email ft.live@ft.com. Two final things. This video will be available for 30 days after today. And if you want to tweet about it all, the hashtag is #FTDigitalDialogues. #FTDigitalDialogues. Phew, okay. That's the preamble out of the way. Thank you again to everyone for being here. Let me start the panel discussion and focus on the short term and maybe even the near past. And I want to direct this to you, Laszlo, to get the IEA's view. Has the pandemic, in your view, in the IEA's view, caused irrevocable shifts in energy demand? And if so, what are they? And how is this going to affect global energy markets and prices in the next 18 months?
The question has three very interesting layers. One, the macroeconomic impact of the pandemic. The second, the impact of the pandemic on social habits and behavior. And the third, the impact of the pandemic on energy policy. And first, for the macroeconomic impact. The pandemic cut global GDP by around 4.5%, and it triggered an oil demand reduction of 8%, which is unusual because it was not a simple recession. It was governments intentionally constraining mobility to stop the spread of the virus. And of course, despite the initial success of electric cars, the overwhelming majority of the energy needs of mobility, moving people and goods are still satisfied by oil. Consequently, the pandemic had a more significant impact on global oil demand than a normal recession would have had. However, I should also add that almost 40%, more than 1/3 of the total reduction of global oil demand was the aviation sector only, which was exceptionally badly hit. Outside the aviation sector, global oil demand declined almost exactly as much as global GDP. So there has been very little change in the oil intensity of the global economy. For the second layer, we have analyzed the social and behavioral changes of the epidemic in great detail, and we came to the conclusion that they cut in both directions. Companies use video conferences much more extensively, and that's likely to be a permanent change. Which will cut oil demand associated with business travel. But there are also very clear indications from major cities around the world that people became reluctant to use public transport. Now, public transport is on average 12 times more energy efficient than individual car commuting. So if you have a person who before the epidemic went to the office every day by underground or train, and that person switches to a lifestyle of home office 4 times a week and going to the office only 1 time, but by car, energy consumption still increases. We also found a rapid shift to e-business deliveries. And even though some e-business companies, including Amazon, are now investing into electric delivery vehicles, the overwhelming majority of e-business delivery is still diesel trucks and diesel vans. So that has also a potential to increase oil demand from the logistics. And last but not least, this is not an oil but a gas demand related issue. But once people work from home, they are much more likely to buy an air conditioner and provide a support for electricity demand, which has important implications for natural gas. So overall, we think that the net impact of the social and behavioral changes is relatively minor because some of them increase oil demand, some of them cut oil demand. So the big question is to what extent governments use the opportunity, never waste a good crisis, to implement green stimulus programs and turn the energy sector decisively into a sustainable development direction. And there we see mixed signals. We see very positive signs. I'm very positively impressed by some of the most recent policies in Europe on electric cars, both in terms of the electric car support policies and also on charging infrastructure. We have also seen very important announcements in the Asia-Pacific region, China committing itself to a net zero society, and of course the transportation sector will play a very important role. Japan has a 2050 zero carbon policy. So certainly we have elements of it, but I should not be complacent. We also see some stimulus efforts were actually quite energy intensive, and still the overall policy stance that governments are implementing is insufficient for a rapid decline of oil demand for energy transition.
Okay, we're going to come to what governments are doing in some detail in a bit, I think. But Jeff, let's just stay at the here and now again. Just focus on that and the present, and looking at the next 18 months, say. You spend a lot of time looking at high frequency data on energy demand, watching, how the market itself adapted to what was going on in the world in the past year. Leave aside what government policy is doing, aside from vaccines and so on, but leave aside those kind of more long-term shifts that may transpire. How did the market, in your view, deal with this pandemic? And do you think the market will figure out lasting change or make lasting changes to the way we consume, say, oil?
Okay, well, I think it's important to separate the vaccine, which is a tactical upside catalyst, from the pandemic itself, which I would argue is a structural catalyst to a longer lasting bull market. So as we look out to 2021, the vaccine creates that V-shaped recovery in demand and prices. But looking beyond that, we believe it's the beginning of a structural bull market, not only in oil, but across the entire commodity complex. And when we think about, looking at, the lasting demand, the big question mark obviously is in jet travel. And we think, vaccine will eradicate a lot of that weakness. There will be some structural losses due to, we're doing Zoom right now, that's going to be permanently lost business travel. But taking that aside, we think the market's going to be in a substantial deficit throughout the end of next year and beyond into 2022. And driving that structural bull story are three themes. One is you have structural underinvestment in supply. We call it the revenge of the old economy. You had very good returns in new economy. Remember the FANG stocks? It took all the capital out of the old economy, choked off the capital that would have created increases in production capacity. Then you throw COVID on top of that, and then you take ESG constraints. CapEx in oil in particular was down 40% in the first half of this year. We've never seen a decline of that magnitude. But it's not just oil, it's metals, mining. The entire old economy has shortages in investment. So that's theme number one. Very similar to a theme we talked about 20 years ago during the dot-com boom that fueled that rally as we went into 2003, 2004. The second theme, which I know you said avoid policy, but I think policy sits at the center of the demand story. And it's not just oil, it's everything. And I think that what the big catalyst that the pandemic shifted is that policy after 08, 09 was directed at market stability. Whether if it was OPEC, it was market stability, or if it was the Fed, it was the Chinese 5-year plan, everything was around financial stability. COVID changed that. Now, whether you look at all the policy, it's all around social need now. And social need creates a redistribution of wealth towards lower income, constrained households that consume a lot more. We already see it in many of the commodity data. I like to point out every single commodity market, with the exception of wheat, is in a deficit today. Demand is relatively strong across the board. And as a vaccine V-shaped recovery takes hold, you're going to get a lot stronger oil demand growth given the policy mix as we begin to look forward. And we call it revving commodity demand. There's three legs to it: redistributional policies, environmental policies, which we'll talk a lot about, and then there's the versatility in supply chains, building duplicate, 5G, stockpiling oil in China due to the Cold War with China. So policy-driven demand is going to create a CapEx cycle that's bigger than the BRICS in the 2000s, not quite as big as the 70s, but we're talking about that kind of a bull market in commodities. And then the third theme, which I think is critical and already underway, is the macro tailwinds from a weaker dollar. And I want to emphasize, this is not something we can forecast out in the future. We're living in it. We're in it. The dollar is getting weaker every day. Oil and commodity prices are moving higher. You have iron ore at a 7-year high yesterday at $145 a ton. Copper is reaching the cycle highs. So this is not something we're forecasting out in the future. We're inside it right now. Our target on oil at the end of the next year is $65 a barrel.
And is that where the rally tops out? I mean, how long does this cyclical bull rally last?
A lot of it's going to depend on the extent of the policy-driven demand. I don't think we're going to go back to an environment like we had from 2008 through 2020, because their policy was primarily focused on dealing with financial stability. So it created a asset price inflation. And the marginal propensity to consume out of wealth is 3%. You don't get any demand out of it. That's why we never got any inflation and never got a bull market in oil or commodities. When we look at, people like to say, oh, it was shale why we didn't get a bull market in oil. That's not true. OPEC offset shale all but 1 year. The core of this is we never had the type of demand growth that creates inflation, commodity bull markets, and creates a rise in wages that narrows the income gap. You have policymakers everywhere in the world talking about they're going to be focused on income inequality. Janet Yellen taking over Treasury has said it. Powell has said it. Lagarde has said it. The Chinese have said it. I think this is the beginning of a real structural shift.
Just on the demand side, especially in the short term, when you talk about this cyclical bull market emerging, the onus sounds to me like it must be on the supply side, the underinvestment that's been on the supply side. And so do you also see demand moving higher over the coming years than it was before the pandemic, or growing at a pace that is equivalent to or greater than before the pandemic? Or is this the story for demand still a slow or gentle?
We actually see, we see 102.5 million barrels per day in 2022. And the point here is that even the environmental policy stimulates more oil demand growth near term. Before we're going to talk about peak oil demand later on in the future, but that's way off in the future. The stimulus of going out and building renewables and everything is going to stimulate more oil demand near term than take away, which is in the future.
Okay. Piers, let me turn to you. And, as the head of the World Petroleum Council, that sounds like good news for oil and gas producers, frankly, that there's a bull market coming for the stuff that they sell. Demand is going to rise. When you talk to your members, do you sense the same kind of optimism about the future? I mean, how are they seeing global demand, not just next year and the year after, but through the 2020s and out into the 2030s? We've had BP saying that in an accelerated net zero scenario, demand could pretty much fall off a cliff over the next couple of decades. What's your view, and what is the view of your members?
There are obviously different views in different parts of the world, and I think what we've been talking about just now is the sort of short-term effects. I think it ought to be said as well that during this last year, despite everything that's happened, the energy industry as a whole has still provided all the products, despite the fact that everybody's been working from home. Digitization has helped. The petrochemical industry and pharmaceutical industry in particular have done amazing things, providing all the alcohols, the sanitizers, all the polymers that people need. If we look further forward, then I think, as Jeffrey said, peak oil, peak gas is way off. as an organisation in WPC, we were formed in the 1930s, and in 1930 the world population was only 2 billion, and people in WPC in 1933 were agonising over peak oil in the 1940s, and so it's gone on through the 40s, 50s, 60s, and so on. And you know, we're now just in a lifetime of WPC, the world population has gone from 2 to, what is it now, close to 8 billion people. So we will still need oil and gas in the future, and coal as well, but we have to use it in a sustainable way. And we always talk as well about comparing with how things were, say, 12 months ago. But we also have to bear in mind that we still have 1 billion people on the planet with no access to electricity. We have nearly 3 billion people with no access to clean cooking. So as well as providing energy in the future from all fuels for the global population, I think that the oil demand, gas demand will continue for some way into the future.
Adair, let me bring you in here, because by the sounds of this, the argument we've heard so far is that the energy transition that we've all been talking about a lot is very much delayed. It's certainly not imminent. It's not going to happen it's not going to start at any pace in the next couple of years. Demand is going to recover. Jeff talked about a V-shaped recovery, oil demand, that is. Some climate campaigns would say we can't afford to burn all that oil. We must speed ahead with this transition, and so on. Do you see it in the same way, or do you see opportunities for clean energy emerging sooner than your fellow panelists have been describing? You're on mute right now, I think.
Well, I see massive opportunities for clean energy, but I think that may still be compatible with somewhat more these short-term bullish points of view on, you know, oil demand in the short term. But what I certainly see is a very major step forward over the last year, over the last 5 years since the Paris Climate Agreement, in the level of ambition and optimism and certainty that we will drive a zero carbon economy by about mid-century, which I think over the 30-year environment has very profound implications for fossil fuels. I mean, since Paris, we've seen an increasing belief across the world that we do have to deal with climate change, and that ideally we should limit global warming to 1.5 degrees centigrade. That broadly means that the world has to get in the industrial and energy system to about zero carbon emissions by mid-century. And at the Energy Transition Commission, which is a global coalition of companies operating in China and India quite as much as in Europe, we believe that that is absolutely possible, that we can get to a zero carbon economy. The fundamental reason why we're so confident is the revolution that has occurred in the cost of various technologies, in the cost of solar, of wind, of batteries, of hydrogen electrolysis, and the ability to decarbonize even the harder to abate sectors of the economy, such as steel and cement and shipping. We've set out why there's a technological vision that can take us to a zero carbon economy with, by 2050, almost no implications for standards of living, and while meeting those extra demands for energy in the developing world about which Piers has talked. And that increasing technological confidence that it's absolutely possible to get there is also what has fed an increasing set of commitments. We have seen China commit to be carbon neutral before 2060, Japan and Korea then followed up with zero carbon by 2050 commitments, Biden administration by 2050, European Union, UK. We have this widening set of major company commitments that they will be zero carbon by mid-century. And we also have a widening set of commitments by companies, steel companies like ArcelorMittal, shipping companies like Maersk, cement companies, global cement and concrete associations, zero carbon. when you put together those company commitments, those country commitments, and the extraordinary pace of technological and cost advance, and let's be clear how big this are. Solar now costs about 10% of what it did just 12 years ago. Wind is down 60 to 70%. Batteries are down 85%. These are fundamental transformations in the relative cost. You put all that together, I'm actually now very confident that we will head towards a zero carbon economy by mid-century. And I think one has to realize how big the consequences for fossil fuel will be. So I'm going to stick my neck out here. Not only should we, but we will end up by mid-century with almost no use of thermal coal, down 95 to 100%, with oil down by that 80%, which is in the BP scenario, and with even gas down 50%. And the big issue with gas is, do we produce our hydrogen in a blue hydrogen route from steam methane reforming plus CCS, or do we do it with electrolysis? And I have to say that in the long term, I think electrolysis will end up as the cheaper route. So put all that together, and I think there is far more basis for optimism that we know how to head towards a zero carbon economy, and we will get there. And you asked me, what do I want from COP26? I think above all, what one now wants from COP26 is to focus countries on the action needed in the next 10 years. Because not only to deal with the climate do we have to get to net zero by mid-century, we've got to achieve sufficient, significant reductions in the next 10 years. And that's where I'm much less confident than I am for the 2050. And that's why what I'm saying may be compatible with what Jeff is saying about the short term. The focus in COP26 has to be to turn those mid-century commitments into really big action. And we've seen one first step forward of that in the UK, committing to get a 68% reduction below 1990 levels by 2030 in what's called its NDC. That's where we've got to focus now, with some really, really big issues. Probably the biggest issue for the global climate is China and coal. China has made a carbon neutrality before 2060 commitment. On the basis of that, it should not be building any new coal plants. The single most important decision, which I think needs to be made, is that all of the growth of electricity systems can and should now be from zero carbon sources. So the 2050 picture, I think, is increasingly clear. The crucial issue is what happens in the 2020s.
Laszlo, I saw you had your hand up there.
Yes. Just for the record, because you mentioned that Mr. Turner seems to be more optimistic than the other panel members, that at the International Energy Agency, we definitely became much more optimistic about the energy transition for precisely the reasons that Mr. Turner indicated. Technology is rapidly improving. The key stakeholders, both in governments and also in the corporate sector, are coming on board. And last but not least, which we haven't mentioned yet, is that most zero carbon energy technologies are capital intensive, but then have very low operating costs. Consequently, the current zero interest rate environment coming from the quantitative easing is a historical window of opportunity. However, what we should keep in mind in relation to the discussions on oil, that in the short to medium term, the most radical, most disruptive changes are unfolding in the electricity sector. So global investment into wind and solar power is now equivalent to around half of Qatar's LNG production not being burned in gas turbines every year. So in every 2 years, solar, wind, and solar deployment displaces a Qatar. But I'm mentioning LNG because only 5% of global oil demand is used in power generation. Now that's primarily in the Middle East, where solar is hands down cheaper. So that oil will be displaced by solar, no doubt, but that's only 5%. Whereas the global oil demand has been driven by factors like trucking in Asia has been 1/3 of global oil demand growth, and that's hard to decarbonize. Petrochemicals play an important role. Before the epidemic, aviation played an important role. So we definitely see a much more optimistic picture for deep decarbonization, but in the short, medium term, global oil demand is driven by factors which are much more difficult to decarbonize than to increase the share of wind and solar in the power system.
Jeff, I'm intrigued by this notion that we can have at the same time progress towards an energy transition, but also a boom in commodity fossil fuels, frankly, in the short term. Is there somehow an incompatibility in that? And I ask that because if we assume that there's going to be this huge price increase and this bull rally that you're talking about, doesn't that imply over time that there will be more and more investments made in the fossil fuel infrastructure and therefore embed the world once more or even further in a fossil fuel infrastructure that takes time to remove? How does that end up leading to the 2050 net zero goals, or does it not?
I think, as Adair kind of alluded to, is that the higher prices speed this process up. You go into COP26 with $60, $70 oil, will be a much different discussion than it is at $45 a barrel oil. And so, yeah, and by the way, I don't think you're going to see it attracting much capital, because one of the reasons why we are bullish on oil is the returns in the sector are terrible. They're not investing in the sector because of ESG issues yet. They're not investing in the sectors. These are just bad companies with bad returns. And so show me a good company with great returns that's not getting capital, then I'll tell you that ESG is the restrictions on capital flows. So, I liken this period to 1999, 2000, we hit $8 a barrel, terrible returns. That's when you created the Exxon Mobils, the BPs and the Shells, the super majors. And coming out of that wasn't until 2005 that capital came back. So you can think of it as just a turbocharged version of 99 this year. It's going to be a long time before capital wants to come back to this sector. And then if it does think about it, given the the ESG backdrop, I highly doubt it's going to. And then you throw on top of that higher prices are going to discourage the demand. So if anything, it's very compatible and actually speeds the process up.
I should remind the audience that you can send in questions. Some have arrived, but anybody else who wants to send one in, do so, please. And you can do that with the chat box on the right of your screen. One question, Adair, let me ask this one of you. Is a carbon tax necessary to accelerate this transition, or can it happen just with the market? And Piers, I'll ask you the same question next.
Well, if before answering that, I could just make a comment on the discussion we had earlier, or what Laszlo said and what Jeff said. I think there is a distinction, and Laszlo has pointed it out, between the pace at which we are now seeing change in the electricity sector, where the zero carbon alternatives are just winning out in terms of new investment, and where that has had quite a big implication for the forward outlook for gas. If you'd asked me just 10 years ago how to get a zero carbon electricity system, I would have said we need nuclear, we need new renewables, and we need gas with carbon capture and storage. I think we are increasingly in an environment where we can set out to build electricity systems which are as much as 80% dependent on variable renewables, and where the role for gas is restricted to a seasonal peaker element, but even eventually there, perhaps replaced by hydrogen. So on the gas side and electricity, a major reduction in our expectation of how much the future comes from either coal with CCS and gas with CCS, and much more expectation of renewables. When you switch over to what Laszlo and others have talked about, trucking, etc., it's simply going to take time. Let's be clear that in light duty vehicles, and I would say up to medium duty vehicles, the future is electric. There's no doubt at all about that. Electric is just a more efficient way of running vehicles, but it simply takes time. Even if you get to the stage where half or all of the new vehicles being bought are electric, it's quite some time before you change the stock. So it's simply a matter of time, which is how I tie together the confidence that we will get to that zero carbon economy, we're still being able to accept Jeff's argument that maybe oil demand might be reasonably buoyant over the next year or so, because that depends not on the flow of new vehicles being purchased, but on the stock that already exists and how much they're being used. On the carbon tax, is it necessary? It's not absolutely necessary. Let's absolutely be clear that a lot of progress has been made with non-carbon tax instruments. Most of the support for the development of renewables has been through various forms of fixed priced auction and a guaranteed price for the provision of renewables rather than using the carbon price as the main tool. Though the carbon price in Europe, in the UK, played a major role in driving the coal to gas switch. However, I do believe that a carbon price is more important when we move to the industrial sectors of the economy. I think in the area of renewables development, you can, if you want, use some other instruments such as direct subsidies, contracts for difference, fixed priced auctions rather than relying on a carbon price. I think in the area of the internal combustion engine, the big driver is just going to be outright bans beyond a certain date of when you're allowed to buy an internal combustion engine. UK now gone for 2030. Watch for a lot of other countries following that in future. I think we will see that. But when you get to steel, cement, petrochemicals, aluminium, what you get is complexes where there are so many different precise things that industry could do to improve efficiency or to bring on board new production techniques, that there you want the subtlety of the price mechanism to drive a search for the lowest cost solution. So I think it is important that we do introduce significant carbon prices, but above all for the industrial sectors of the economy. They will help reinforce the progress in renewables, but we've actually made a lot of progress around the world on renewables without relying primarily on a carbon price.
Piers, let me bring you in. Jeff mentioned that oil prices will rise, but nobody's going to invest or will want to invest in oil companies because they're just not making money at the moment. They're a bad investment case. As the oil industry's representative on this panel, how does that make you view the future for your members?
The future for all our members is very good because we can still use oil and gas with zero carbon. I think just to go back to discussion on COP. In fact, you would have interviewed Mohammed Bakindo. Now, I first met him at COP1, and I was at COP1 promoting carbon capture and storage. And here we are coming up for COP26, and we don't seem to have made an awful lot of progress. As far as I'm concerned, Kyoto back in 1997 was one of the better agreements because it had legally binding emission targets, but that's why lots of countries didn't sign up. Paris was good because so many people signed up to Paris, but we haven't done an awful lot since Paris because everybody's talking about COP26 and what we're going to do, but we're not going to meet our 2-degree or 1.5-degree target by next year. The current estimates are we're looking at 3 degrees. So we have to do something. One thing we can do is to get politicians at COP26 to sign up to Article 6 and actually have a carbon tax that is agreed to globally and it is fair. We also have to look at ESG and other mechanisms and perhaps put some caveats in like the European Union has done for what your definition of E is, so that you're not replacing one pollutant for another, so that even though if you don't produce carbon, you're sustainable is what a lot of people look at. So the EU putting their do no harm caveat in, I think is quite important as well for the future. So we're not replacing carbon dioxide with nuclear waste that's going to last for multi-generations. But I think if you want things done quickly and after COP26, if you want to bring down global CO2 emissions, then the key is to use existing infrastructures, which you have with gas, and to use carbon capture and storage, where you can get rid of vast quantities of carbon dioxide quickly. just in the last 25 years in Norway, we've seen with Sleipner that 1 million tons of CO2 has been safely sequestered under the North Sea, forming harmless carbonates. I think that's the direction that we need to go for the future. And to help us do that, a global fair carbon tax agreed at COP26 could achieve that.
I suppose one of the counter arguments on the CCS front is that the scale of the requirement is so great, and if there was any industry that had an interest in developing it at a cheaply, it would be the power generation sector. In the US, for example, there are 1.6 billion tons of emissions from power generation. It would have been in the interests of the coal-fired generators to begin sequestering some of that, presumably, but they haven't. Is that not a failure of the industry? I mean, the argument that I've heard from CCS proponents is that a carbon tax would have made it viable. We don't have those, at least not at the price necessary to make CCS a viable technology. Why doesn't the oil industry? I mean, ExxonMobil is investing some money in CCS, but seems to have stalled on some of these projects too. Why isn't the oil industry itself doing this if this is going to be the solution for sustaining the industry over the long term in this transition?
I think you find the oil industry is. If you look at what Norway is doing, what the UK is doing, all the current projects being released by BP, Shell, and others, everybody is looking at carbon sequestration. That has to be the future. And again, with a gas industry, you can replace gas for coal in power generation. That reduces about 50% of your emissions. But with some of the sophisticated petrochemical plants, when you're looking at methane, hydrogen, you have great opportunities for removing CO2 from the stream and either storing it or utilizing it.
Laszlo.
Yes, so a couple of things. One is that I'm an oil industry veteran. I used to work in the industry, and I've been outspokenly critical of the industry not moving into carbon capture and storage investments in a more strategic, more systematic fashion. You could observe in the past decade that major oil companies have been very comfortable making multi-billion-dollar investments in things like Arctic offshore, which makes sense only if there is no rapid energy transition. But they were very shy to make investments like big carbon capture and storage projects, which make sense only if there is a rapid energy transition. So the oil and gas industry has had an asymmetrical risk perception and has been much more comfortable investing in high carbon trajectories than in low carbon trajectories. And I think this is now shifting. Some oil companies that were mentioned, especially the European headquartered majors, have made a very impressive progress recently. But overall, the industry, in my view, is still lagging behind. Now, another thing we have to keep in mind is that, and then I just a response to your comments on the US power sector, carbon capture and storage, in our view, is primarily not a power generation technology. We might need to refurbish coal-fired power plants in Asia with carbon capture and storage, because there the coal fleet is very young and it plays a critically important role in energy security. So there, carbon capture and storage will play a role, and we might need gas plants with carbon capture and storage for seasonal balancing, or we might use hydrogen or other technologies for that. Carbon capture and storage, in our view, is absolutely essential for the heavy industry. So for the steel industry, for the cement industry, for the petrochemical sector, it's absolutely essential. And last but not least, I mean, let's be honest, there is a very high likelihood that the carbon concentrations will overshoot. And consequently, there is a very high likelihood that we end up having to remove carbon from the air. And carbon capture and storage is a technological solution for that.
Mm-hmm. Jeff, let me ask you, when we turn to these kind of technologies, given the, I mean, notwithstanding what Laszlo just said about carbon capture and storage being used for industrial processes, not necessarily power generation, do you feel, given the fall in renewable power generation costs and so on, do you feel that there's still a future for natural gas-fired power plants or even coal-fired power plants plus CCS, or is it, you know, in power generation specifically, is the game just over now? It's renewable energy from here on out.
When we look at battery technologies, I like to point out we've had 100 years to figure these technologies out, and we haven't done a very good job of it. I mean, you just look at a chart of Moore's law with processing speed, and you look at batteries next to it, it's pathetic. Which begs the question, are we going to get a breakthrough sometime in the next several years? It's probably unlikely, which is why I agree with Laszlo that the importance of investing in carbon capture technologies, because the bottom line is the best we can do is at this point 48 hours of storage at an industrial level, which means the renewables still need the natural gas to deal with the intermittency problem. The natural gas is the battery right now. And so when we think about the future of natural gas, if you have all this renewable investment, which I agree with 100%, it stands on its own 2 feet. Right now, the only battery to deal with that intermittency problem when the sun doesn't shine and the wind doesn't blow is natural gas. And so the future there, and if you throw, carbon capture technologies on top of it, it'll have a future. By the way, on that, when I think about the whole climate change, we either got to figure out how to store electricity with battery technology, or we got to figure out how to store carbon, because we can capture it, we just can't store it. So they're very difficult problems, but we're a long ways from solving either one of those. So I think, in terms of the future of gas right now, whether, another promising one is blue hydrogen as well.
Let me ask you about these technologies specifically. Hydrogen is having its huge resurgence in the narrative, at the very least. How much faith do you have in that technology, blue or green?
Well, just briefly, can I just say briefly on carbon capture and storage? I maybe disagree a little bit with Jeff here about, do we need gas as the battery? Look, there are two different, well, there's a range, but you can think about two different challenges in balancing an electricity system when the sun doesn't shine and the wind doesn't blow. One is the diurnal balance, day to night, keeping your air conditioners running in the evening when the sun's gone down. The other is the seasonal balance issue. I think increasingly on that hour-to-hour and diurnal balance issue, batteries are completely competitive. And we're actually seeing around the US various utilities cancelling gas turbine orders and going down the battery route as well. And the work that we're doing in India, where the big challenge is the biggest supply of renewables is solar rather than wind, and the biggest balancing problem is a diurnal balance rather than Northwest Europe, where it's a seasonal balance. We see solar plus batteries going to be something which is probably going to outcompete coal and gas. Gas is less relevant in India. So the crucial thing on CCS, I basically agree with Laszlo. 10 years ago, if you'd asked me, I thought there was a major role for CCS in the power system. I think it is now relatively small and either transitional to new forms of balancing in future, or, as Laszlo suggested, regional. As for hydrogen, however, I do think that this is going to be a major technology. The scenarios we've been seeing, we have set out, suggest that we could need to go from 60 million tons of hydrogen to as much as 600 to 800 million tons of hydrogen being used in the global economy by mid-century. Interestingly, I think almost none of that will be used in light-duty vehicles. I think hydrogen went through a complete cul-de-sac of people believing that the future of the hydrogen economy was competing with the battery electric vehicle in light-duty vehicles. I fundamentally think batteries are going to dominate light-duty vehicles, and that the Japanese in particular are still, smoking something when they think that they're going to develop a large hydrogen auto business. But when we look at how do you decarbonize shipping, where the major container shipping company in the world, Maersk, is now committed to be zero carbon by 2050. The front runner technology is probably ammonia made from hydrogen. Actually, in steel, maybe a little bit of a difference from what Laszlo said. I think CCS will play a major role in cement. I can't see an alternative to it in cement, and probably in petrochemicals. I think in steel, an increasing feeling that in the long run, direct reduction using hydrogen is going to beat CCS in the steel area. Possible role in e-fuels, in aviation synthetic fuels, a wide variety of other uses. and certainly a major possibility in the trucking environment, the long distance heavy goods vehicle environment where batteries won't be enough. So overall, yes, we believe this hydrogen story, and we certainly believe that it is absolutely possible that the cost of green hydrogen is going to come thumping down. A lot of people out there talking about producing green hydrogen from electrolysis at less than $2 per kilogram within the next 5 to 10 years. Completely believable given what we know is now happening to electrolyzer costs and renewable electricity costs. And of course, you only need to know two things to get your cost of producing green hydrogen clear. You need to know the capital cost of the electrolyzer per kilowatt, and you need to know the cost of your electricity input per kilowatt hour. Put those two together and it's dead easy to work out what the cost of a kilogram of hydrogen is going to be. And we see that really coming down quite dramatically in the next 10 years.
Let me change tack slightly and ask about the economics of all of this. And Jeff, let me start with you first, because Goldman Sachs has done some fascinating research showing that there's this opportunity for, I think, $16 trillion worth of investment over the next decade in, vaguely speaking, transition type projects. I mean, that's a colossal sum. I think it was compared to the amount that was spent on infrastructure in some of the developing economies in the first decade of the century. How does all that get financed? Does the market figure this out on its own? Does it need governments to do something? Does it need the White House with a big federal spending plan of the kind that Biden envisaged? I mean, how do you see this all transpiring?
Okay. Yeah, first, the short answer, buy copper. Copper sits at the center of all of this. By the way, I want to go off to Adair's point about the batteries, and it goes to the metals markets. Right now, Tesla and Apple consume 50% of the world's lithium market. These metals markets cannot accommodate scaling up these battery technologies at the rates that are potentially anticipated here. But going back to your question, the scale of this CapEx cycle. I said before, it's a little bit bigger than the brick cycle of the 2000s, not as big as the one in the 70s. We do that 16 trillion. But let's say over 10 years, that's $1.5 trillion each year. By the way, we're off to the start in 2021 when I go around the world between China, because remember, you take the 5-year plan in China, green investments, one of the three legs of it. In fact, it's the same 3 legs everywhere: redistribution, green, and then something to deal with, resilience of supply chains. All of them are focused on that, whether it's the US, Europe, or China. Right now, we look at, with Biden, with the constraints of a Republican Congress, and Georgia will be a very important outcome on that. We're kicking this decade off with, about $500 billion. So far short of that 1.5 trillion. But I think one of the key points here is we think it's going to be a public-private partnership, which means the public's going to spend. Now, this goes into that whole view about, the type of policies very different this time around than what we saw after the financial crisis. And when you have these big spending programs, particularly on infrastructure, and almost all of it's directed at, green investment on both sides of the Atlantic as well as in China, means it's going to be very similar to lower income groups, which is what creates that positive economic backdrop. And so, that's where do we think it's going to come? It's going to come from the public and the private, but a big chunk of it's going to be public, because you got 2 things you need to spend on. One is social need. One is climate change. They come together, and you can solve 2 problems with the same type of investment. So we think this is the beginning of it, and it's probably got a lot of legs of it going forward. And let me remind you, it's not just US and Europe. It's embedded in the 5-year plan in China, and China is a big driver of this CapEx.
Okay, and invest copper in copper. You heard it from Goldman Sachs. Okay, I'm going to turn to some audience questions, because there are quite a few that have come in. Thank you, audience. Very helpful for me in particular. Let's start with what about the geopolitics of this? Pierce, which big oil producing countries will benefit and which will lose from this transition over the coming decades? How significant a geopolitical event is this?
I think it's very significant. You can see that some of the major countries such as UAE and Saudi have visions for the future, which includes the transition to a less carbon environment. But I think there'll be severe challenges in other countries that rely 100% on fossil fuels. And as we move, I suppose, more towards electricity, moving electricity or moving electrons around more than molecules, we will have other geopolitical issues arising, which I think Jeffrey's hinted at when he's talking about copper, but you've also got to look at where lithium, where nickel, where cobalt, where all these materials are in the world that we're going to need for all these batteries, for the transition metals that we need for all our gadgets of the future. So I think perhaps towards in 50, 60, 70 years time, I think the sort of energy powerhouses, if you like, will be wider spread as we have more renewables. And I think most of the major current oil and gas producers are looking in that direction, and they're looking at circular economies, and they're looking at producing everything in a more sustainable way.
That's a nice segue into another question from the audience. Adair, do you have a view on the circular carbon economy as advanced by the Saudi G20 presidency?
The circular carbon economy or the circular economy? I mean, they're both. I mean, let me just comment on the circular economy and make one point in relation to lithium. There's no shortage of lithium in the world. If in 2050 there were 2 billion electric cars on the road, and they each had a 50 kilowatt hour battery, the amount of pure lithium we need as a stock in those batteries is 19 million tons. The US Geological Survey has just increased its measure of global resources of lithium from 50 million tons to 80 million tons, reflecting the classic pattern that we know that every time we need something in the world, our measures of resources go up. We've seen that in fossil fuels. We keep on finding out that there's more and more than we thought there is. There is no shortage of lithium. There may be bottlenecks about production capacity as we head towards that, but it's not limited. And the reason why I make that point is it's important to understand that the renewable economy truly is in some sense circular. What you do with lithium is you put it into a battery, and then it again and again, year after year, moves an ion backwards and forwards from the cathode to the anode. And broadly speaking, it doesn't wear out. Well, it slowly wears out, but it's completely different from a fossil fuel economy. To drive a fossil fuel economy, we have to dig 7,000 million tons of coal out of the ground each year, burn them, and then do the same the next year. To build a lithium economy, you have to take 19 million tons out, put them in a stock, and broadly speaking, they don't disappear that year. They slowly degrade. Now, because they slowly degrade, we also have to maximize the amount of recycling. So the issue of how we recycle steel better, recycle concrete better, which you can do to a degree, recycle lithium and cobalt and nickel in batteries, that is going to be an important thing as well to reduce the environmental footprint. And so there is a very major theme there. I think by the circular carbon economy, I think this sometimes for some people overlaps with the idea of carbon capture and storage, and the idea that this is the sort of magic thing that keeps demand for fossil fuels going. We talked earlier about that. Where I do see a major circular carbon economy is in plastics. I mean, let's remember that plastics are inherently made out of carbon. I mean, electricity doesn't need to be. We can make it with nothing to do with carbon in future. Plastics, as long as we release plastics, these things are made out of the carbon molecule. And I think we should and we will move to an environment where we are circulating that carbon molecule round and round whether that be in mechanical recycling of the basic plastic types, or whether it be in chemical recycling, which I think is going to also be affordable once we have renewable energy cheap enough. So broadly speaking, the circular economy is a very important theme. It has a subset of it which relates to the recirculation of carbon molecules, but I would be wary of believing that that is, as it were, going to provide a lifeline for the whole of the fossil fuel economy. Having said that, to go back to the question Piers answered earlier, if I were the Saudis, I wouldn't be very worried about their oil market. Let's be clear, if there are 20 million barrels of oil a day being used in 2050, probably 10 of them are going to come from Saudi, because that's going to be the cheapest place to produce them. The challenge is people sitting on high cost oil. And I think high cost oil is ultimately a stranded asset, both for companies and for countries. And they need to realize that and have plans to diversify away from it. But the Saudis are not in that position. They can probably pump, what, 10 million barrels at a marginal cost of no more than about $8 a barrel.
Jeff, is that the way you see it playing out over the next 2 or 3 decades? This gradual shrinking of the oil market, leaving only the low-cost producers battling for a very small, for slices of a very small pie?
I think there's too much uncertainty about the technology that's going to be used to solve climate change, as well as the politics of funding this and how you get there. We haven't even started to tackle the politics of this. The one thing I want to say about carbon capture is that it's a winner-take-all technology here. If you find one of these that work, it works for everything at a low cost. And I point out, then it comes one of these technology that works that dominates. It'll knock out all the others. We watched that with shale in the oil industry alone over the course of the last decade. So, the other thing, in terms of we don't know how fast we're going to have to solve this problem with climate change. It's creeping up on us a lot faster than I think most people would have thought 5-10 years ago. So I think there's a lot of uncertainty in terms of how that path takes place. I just will say this, having watched commodity markets across the board for 30 years now, is that when these adjustments takes place, they're usually very violent and very swift. So I highly doubt it's going to be a gradual process. It'll probably be much quicker and faster than what we think.
Mm-hmm. Laszlo, we have just 3 minutes to go, 2 minutes to go, I'm told. There's just one question on CCS I wanted to ask you as well. You've been pretty gloomy about CCS. What about CCR, carbon capture and recycling, or CCUS, the utilization part?
Sure. So on CCS and carbon utilization, what we have to keep in mind is that the objective is that fossil originated carbon atoms cannot go to the air. Okay, this is the objective. Consequently, for carbon utilization, you either produce things, for example, jet fuel, where it is useful to have carbon, but the carbon ends up in the air from the aircraft. And in that case, the carbon has to originate from a non-fossil fuels, either from a biological source or you capture directly from the air. And this is why companies are investing in direct air capture and jet fuel production. Or you capture fossil originated carbon, and then you have to have a utilization source which prevents that carbon atom going to the air for centuries. And the only good candidate to that, in my view, is building materials. So if you capture carbon from a gas-fired power plant and use it in a glass house to grow tomatoes, that carbon atom will go to the air, and you don't have a lasting climate benefit. But there are also companies who use captured carbon for building materials, for new types of concrete, and so on. And that's a very interesting option. So carbon utilization is certainly rising on the agenda. But I also have to say that a lot of the advertised utilization projects, when you do the proper accounting of where that carbon ends up, do not produce a real climate benefit. And we have to be quite disciplined with starting from the principle that fossil originated carbon cannot end up in the air. Now, so back to the oil ones, I do agree that low marginal cost producers will continue to produce physically their oil. But in an energy transition trajectory, that oil will generate much, much lower intramarginal rents, which are currently paying for the entire social and governmental systems of multiple countries. So we think that in an energy transition trajectory, the major oil producers have give or take 1 decade to implement quite throughout deep economic reforms, develop the non-oil sectors of the economy, and create a competitive, viable market economy in the non-oil sectors. Now, in a number of major Middle Eastern countries, including, of course, in Saudi Arabia, the political leadership very much recognizes the importance of this. But it's fair to say that they still need to do a lot of practical implementation of this.
Thank you. Well, we are running out of time. I've been fascinated by the discussion. Unfortunately, we have to leave it just as we get into another big, huge topic of the geopolitics of the energy transition. But thank you for your contributions in such a kind of short period of time at the end there, gentlemen. I hope all of you in the audience have enjoyed this as much as I have. We look forward to seeing you at future events. Remember, you can watch this one again if you want to. It's available for another 30 days on the website. Remember, too, you can also use the networking feature at the top of the website afterwards if you want to talk to other delegates. Thank you, audience. Thank you, panel. And thank you also to our partners, the Al-Attiyah Foundation. Thank you. Have a good day.